This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore.
So apparently my pictures I shared on Teams for the office inspired you to go kayak shopping.
Well, a couple of years ago, you always, just so everyone understands, Cameron always posts pictures of himself with his son, James, kayaking.
James loves kayaking. He just got a roof rack for his car. He's crazy. That's his happy place.
And so it's always these pictures of like Cameron's feet with the front of a kayak and then, trees and water. And I grew up in a very small town in British Columbia on the water my whole life. I lived on a lake until I was 12, and then I lived on the ocean until I left home for university. So I love being on the water. Living in Ottawa, I don't get out there that much. So Cameron's pictures always made me jealous. And so like you said, I went and bought a sit-on-top kayak like the one that you have.
So is it enough for you and how many kids?
I can take the two boys with me.
Awesome.
So we all wear life jackets, and it's a 12-foot fishing kayak. So there's plenty of room for me to sit in the middle and plenty of space for the boys to sit in the front and the back.
Yeah, there's lots of great kayaking places in Ottawa. It's funny, you came out to the launch near where I live. I think we were maybe like 500 meters apart without even knowing it on the weekend.
Well, I go there because I went with you like 2 years ago. I came and met up with you and I rented a kayak. And then so I go back to the same place to launch because I don't know where else to go. That's the only place I've ever launched a kayak from in the city.
What we have to do, we have to get you out there, and I'll bring the drone. Be awesome to drone the boys kayaking. That's a good idea. Super cool. Anyways, I wanted to mention a couple of guests that are coming up because the books are really worth looking into. So first one's Jim Stanford's book, Economics for Everyone. Not easy to find, but if you can find it, it's great. That was a phenomenal interview coming up. And also Dr. William Bernstein is coming up. This is a big guest. He has a dozen or so books. I've read, 4 or 5 of them. I think they're all excellent.
Pick one,
read it. They're incredible books, incredible interviews coming up.
Yeah, the Jim Stanford one, and I think in the interview with him, we just talk about how much we loved his book. So I'm going to do it again now. Sorry. I've been getting a lot of questions about monetary policy, quantitative easing, and the relationship to asset prices, and just money in the banking system in general. I think that it's generally really poorly understood. And I know I've talked a couple times about how we're planning on doing a podcast episode and probably a video on that topic. The section of Jim Stanford's book on money and banking was the perfect summary of all of the other research that I've done. Like there's not a more concise resource to understand money and banking in a capitalist economy than what Jim wrote in his book. So anyway, for anyone wondering about that or thinking about that, that's one of the best resources that I've found to understand it.
Yeah, we also want to do some more work on the book part of the website, get a more current list, and perhaps reorganize it by books recommended by or written by guests and then books recommended by us. It's quite a long list now. I guess we're doing a lot more reading than, or at least being more public about it. So it's a long list of books, but getting lots of great feedback on it, which is nice. Yeah,
we do want to organize it better. The discussion on the rationalreminder.ca website is it's pretty robust. Like every day there are people commenting and I jump in there when I can. I wish I could do more, but obviously time's a constraint. But the other podcast listeners are discussing topics with each other, and people are getting really good answers to questions. It's really cool to see. Yeah. And I put a note on top of that page the other day because I was using Control F to find comment threads on different topics, and I realized how well Control F works because it's a big unorganized thread. There's no you can't sort by section or anything, but Control F is phenomenally good for finding a topic within that big huge discussion.
Anything else to add?
No, as always, if you want to ask questions about this episode specifically, go to rationalreminder.ca/podcast/105 and we'll try and answer you there.
There you go. Enjoy the episode.
Welcome to episode 105 of the Rational Reminder podcast.
Can you believe the big news last week? At least it was pretty big news in our world. Dimensional Funds announced an application for entry into the ETF marketplace.
Yeah, I got a lot of messages from people about that.
Yeah, so I know we have a pretty keen audience on this, advisors and investors included. So we'll go through what we know, what we don't know. But one thing we do know is that they announced on Friday that they filed a preliminary registration statement with the Securities and Exchange Commission in the US for launch of 3 actively managed ETFs, and they're planned to be launched later this year. So what we do know is that there will be 3 all-cap core funds, one in the US, one non-US developed, and one emerging markets. So these will all give investors access to Dimensional's approach, including tilting towards the parts of the market with higher expected returns that we've talked about since day one on this podcast. So co-CEO Gerard O'Reilly last week in an interview on BNN Bloomberg said, as ETFs have become more important for servicing their clients, our clients have asked repeatedly, can you guys launch ETFs? We see them as a great complement to our mutual funds, is what he said.
Yeah. One of the parts that I've found most interesting about the level of curiosity that people have had about this is the fact that Avantis, which we've mentioned a few times on the podcast, launched in October last year. And I mean, I don't know how Dimensional would feel about me saying this, but they're basically the same thing. Like on implementation and philosophy, they're intentionally pretty close to identical. And Avantis has launched both mutual funds and ETFs. So that's kind of been my response when people ask me, how does this affect the market, or how does this affect model portfolios or anything like that? And it's like, from a portfolio execution perspective, Avantis kind of checked all these boxes. Now I'm saying that we don't actually know what the Dimensional product is going to look like. Like I don't think that we know what the underlying tilts are going to be.
We do not. We don't know the fees. I've also been asked whether they will have Canadian-based ETFs. That's not known either right now. This is only an SEC filing. But to your point, one thing I do know is that a lot of people kind of jumped on the speculation bandwagon on Twitter on the weekend, which I somewhat amusing, I guess, to me. One of them is Avantis. They must be worried about Avantis, therefore they came out with ETFs just to beat Avantis. Some people have speculated they could have owned the ETF marketplace had they come out with ETFs earlier. But I think the big breakthrough was the rule that changed last September, which enables them to do custom basket creations. This is somewhat technical, and we're going to cover it off in another episode. But this ability to create custom baskets throughout the day is what I think is the breakthrough that enabled them to go ahead with something that will work for them and the way they manage money.
It basically allows them to be a little bit more flexible in their trading on implementation than prior to the rule.
Right. So there will be ETFs. Everyone who has access to US-based ETFs will be able to get them. So that's a little bit different than their mutual funds, which are only available through authorized advisors, even though there are some ETFs available from John Hancock, I believe, that use their strategies but aren't traded the same way as DFA necessarily would trade them.
Yeah, well, so Dimensional is filed for actively managed ETFs, whereas I believe the John Hancock ones are index ETFs that track indexes created by Dimensional for John Hancock.
Right. That's right.
So in the John Hancock, those are Manulife ETFs in Canada. In those ones, you don't get the daily implementation that we sometimes talk about as being pretty important to capturing the higher expected returns. But with an active ETF, which is also what Avantis is, you get that daily implementation. And with the custom baskets, it allows the implementation to be even more flexible. So that's likely one of the drivers behind Dimensional entering the ETF space. I think
they had a lot of demand. My guess, this is speculation, I don't know. But if I'm going to enter the speculation game, I think it was demand from advisors who work with Dimensional now who have ETF-based portfolios. for whatever logistical reason, they only want ETFs. This enables them to include dimensional in their model portfolios. I think that would be a lot of demand, would be my speculation.
Yeah. And then there's a lot of talk too about the tax efficiency of ETFs, which in the index fund space, you could probably argue is an overstated benefit. Not to say that there isn't one. This is specific to US listed ETFs. In Canada, we don't have the same potential for a tax benefit. But with the US listed ETFs, they're able to kick out the low cost base shares
Right.
through transactions with the authorized participant, which can end up being a tax deferral for a portion of the gains within a fund. It doesn't eliminate the tax because
Right.
unit holders still end up paying it, but it can be a deferral.
Right, because that swap out doesn't change your own cost base of your shares.
Yeah. So I think when we hear about demand, or if we assume that well, it must be demand is driving Dimensional to launch this, otherwise they wouldn't have come out with it. But some of that's probably coming from that sort of view that ETFs are much more tax efficient. But again, I think it's true theoretically. Is the magnitude economically meaningful or not? I don't know. That's probably debatable, especially in low turnover funds like Dimensional or other total market index funds. I think one of the, like you mentioned, people kind of jumping on Dimensional for launching this in response to some external thing, like maybe Avantis having ETFs, and that gives Dimensional a sort of kick in the pants to get into the ETF market. But you think about like I don't know, profitability as a factor, which has been known about since 2006 at least. Fama and French published a paper talking about it, and I think it was 2012 that Novi Marks came out with his paper where he actually identified a way to measure expected profitability. So 2012, and then it was 2014, I think, that Dimensional started rolling out profitability in portfolios. So that's years of lag time for something that's fundamental to their investment process. So I think the idea that, Avantis launched products in October last year, and knowing how methodical Dimensional is, to think that they all of a sudden decided to rush to create a product to meet market demand, I think is kind of, or not to meet demand, to combat what Avantis has launched.
That's one of the things we've found for years so appealing about how they operate. Everything is so thoughtful, methodical, systematic, and they're a slow-moving firm, and it's been a good thing, right? I've been through many years of fast-moving firms, and we'll give a good example later in the episode. I like it that way personally. Like, do things carefully, make sure you do it right. But my favorite comment in Twitter this weekend was, here's the quote, just talking about them getting into the ETF space. So someone says, it will likely happen over several years when ETF fund flows far outpace advisory mutual fund flows. At that point, DFA will likely go all in on ETFs. Then there's 2 stars. This is only my opinion. I know nothing about the inner workings or thinking at DFA. But you still had an opinion. Another one, more asset grab obsession. Here's another one. This ship has sailed. Somehow we'll have to figure out how to tactically manage or even profit from volatility. Buy and hold with FAMA factors has been too painful.
So volatility trading, a la AIMCO, the Alberta pension manager that just lost a bunch of money.
Ouch. Yes.
Is that too soon to make that comment?
Yeah. Anyways, in the end, I don't see this as a negative. It gives more people access. And if you're going to want to, one of the things about limiting access to dimensional funds is to basically protect all the investors that are there. And one of the benefits of the ETF structure, we've talked about this with Dave Nottig in the past, is if you really want to get out, then you will have to pick up that spread, right? So it pushes those
That's the huge difference between mutual funds and ETFs. And this is why Dimensional is able to do this without as much concern about the existing unit holders of the fund. Like you said, Cameron, with a mutual fund, what new investors do, or what investors leaving the fund do, affects the existing unit holders. But with an ETF, it's the authorized participant that bears all of the transaction costs. Now, you could still have an impact on the spread, which could ultimately still cost people who are transacting in the fund money. But that need to protect the unit holders of the fund by limiting access, a lot of that goes away.
Yes.
With the ETF structure.
Yep.
But I do still think that, well, I do still think that the, you just hope that investors do a good job if they're going to use these products of staying disciplined. Like I think all of those ideas of, stay invested and all that stuff, the core fundamental concepts of passive investing in general, I think those get more extreme when we start talking about the tilts, because it's one thing to hang on through bad market returns when everyone else is having bad market returns, but to hang on through subpar portfolio returns when the market's doing pretty good, like we've had for the last decade with small cap and value trailing, that I think that's a lot harder to hold on through. I mean, it's like that tweet that you just quoted, that it's been too painful to implement Fama French factors. And that's always going to be true. Like pain is, that's why you have a positive expected return.
I'd be surprised if there's a groundswell of demand from typical do-it-yourself investors. There might be, but I kind of doubt it.
No,
there's no shortage of product out there now in this space. And you can debate what is better or worse, but there's not a ton of demand. There's so many of these factor type funds out in the marketplace now.
But Avantis is the perfect sample. If we're going to think about how do we think these dimensional products are going to do, Avantis has gathered what, $1 billion in assets?
Billion and a half, something like that. Yeah.
So it's not like they're exploding. And I think that what they've launched a very good product, and no doubt Dimensional is going to launch a very good product too. But yeah, I don't know.
And
I don't think this is earth shattering in any way.
No. And another Dimensional news, probably worth mentioning, that they announced recently that they're going to be reducing their management fee on 16 of their funds in Canada. May not sound like a big deal. It's between 1 and 5 basis points. So if you look at a typical, their 50-50 portfolio, the prepackaged portfolio, the F-class management fee goes from 30 basis points down to 26 basis points, which again, 4 basis points doesn't sound like much, but it's a 13% cut in fees. So I think this is a good thing.
Of course, it's a good thing. Absolutely.
Yeah. And last little bit of news before we get on to your main investment topic today. So there's a chart that was all over Twitter a couple of weeks ago showing, and I know I mentioned this in a couple of, I don't think we mentioned it on the podcast, but I know I mentioned it in a few client meetings. This chart that was everywhere showing that a third of all investors in Fidelity over the age of 65 had, and I quote, sold off all of their equity holdings. And it was a pretty staggering number, but it was everywhere. Anyways, accidentally, I came across a correction that I saw in the Wall Street Journal last week. So instead of saying that 1/3 of all investors in Fidelity over the age of 65 sold off all of their holdings in the recent downturn, it should have said, of the 7.4% of investors age 65 and up who made a change to their portfolio between February and May, nearly a third moved some money out of stocks. Also, of the 6.9% of investors across all age groups who made a change, 18% moved some money out of stocks. So the original tweet and chart that was everywhere just showed those high numbers, a third moving all their equities out. So it's not nearly as dramatic as was originally purported.
Interesting. Yeah, I remember that chart being everywhere, but the correction has not been everywhere. Funny how that works.
It is not. I don't know about you, but I have no books of the week. I know we're getting more and more people commenting that the talk we mentioned about books.
I got a book I started reading. It's heavy in the literal sense that it's a large book, but it's also the concepts in the book are heavy. It's called Capital and Ideology, by Thomas Piketty, who's a French author.
How did you find it?
Someone told me about it. I have his previous book, which is called Capital in the 21st Century. But I've only read the beginning of the book. Just listen to this though. Like you'll understand what I mean by heavy. I'm quoting the introduction of the book, just the very first sentences. Every human society must justify its inequalities. Unless reasons for them are found, the whole political and social edifice stands in danger of collapse. Every epoch, therefore, develops a range of contradictory discourses and ideologies for the purpose of legitimizing the inequality that already exists, or the people or that people believe should exist. From these discourses emerge certain economic, social, and political rules, which people then use to make sense of the ambient social structure. Out of the clash of contradictory discourses, a clash that is at once economic, social, and political, comes a dominant narrative or narratives which bolster the existing inequality regime.
Wow.
Yeah.
And that's the introduction.
Well, that's the first opening sentences of the book. But Capital in the 21st Century, his other book, it's like it's this, again, physically large book about a lot about inequality, but everything is data. Like it's a data based book, as is this one. Yeah. Anyway,
Wow.
There's my book recommendation.
Okay, we'll wait till you read more of it to get the full recommendation, but we'll talk about it next time. On to our portfolio topic this week, private equity. So we talked about this earlier this year, how popular private equity is getting. And I mean, at the time we talked about how Vanguard is getting into the private equity business with a relationship with HarborVest Partners, which is a Boston-based private equity firm. So you did some digging into this topic.
Yeah. And Vanguard, when I was researching this topic again, I think an important point about the Vanguard, and I'm sure we mentioned this last time we talked about it, but they only made this product available to their institutional customers. So it's not like you can go and buy a Vanguard private equity ETF, at least not for now. But yeah, so according to PitchBook, which is a Morningstar data service focused on, well, VC and private equity, private equity attracted $301 billion in new assets in 2019, which broke, and I think I remember talking about this last year, or earlier this year maybe. Anyway, so that broke the previous record for private equity new assets, which was in 2007 with 267 billion of new assets.
So what's your objective when you dug into this? Like, did you have a thesis in mind of where you're going with it?
About private equity?
Yeah.
No, a lot of this research is actually research that I did for a client earlier this year. And I've just known that I've had it sitting there dormant and haven't gotten around to make it into a YouTube video. So I thought it would be a good...
But you don't set out to disprove it or explain it by factors. You just kind of go where the research takes you? Or did you have an idea in mind of where it would end up?
Well, it all comes back to asset allocation. Like anytime that we're researching a thing, it's like, does this thing belong in portfolios? And sometimes that comes from our own questioning. Like when Avantis launches products and all of a sudden there's a US listed ETF version effectively of dimensional funds, even though that's not exactly what it is. That spurs research into, does it make sense from a portfolio efficiency perspective to include these US listed ETFs in portfolios? So that was an internally motivated research project.
But so you're looking to do research on whether it makes sense to include this in your asset allocation, not necessarily pass judgment on this as an asset class on its own.
No, I mean, I don't care. I mean, I do care. If it's something that makes sense for clients to hold, then we should be including it in portfolios. Now, in a lot of cases, I'm making an assumption without doing the research that it doesn't make sense to include just because it wasn't previously included in portfolios. Like PWL has been managing portfolios since long before I arrived. We don't include private equity. You kind of have a bit of a preconceived opinion on private equity. So you assume that it doesn't make sense. But then you get a question from a client specifically asking, why aren't we doing this?
Yeah.
And then all of a sudden it's not enough to say, well, that's just the way we do it.
Yeah. And you're lousy at winging answers.
Yeah.
With all due respect. It's not your forte.
Is that like our what did we try and call those? The rapid fire listener questions that ended up not being so rapid fire?
Okay, dig in.
Yeah. But that's it. To answer your question, though, it is the basis of the research is, should we allocate to this in portfolios? Is it adding something to portfolios that you couldn't get otherwise? I mean, you think back to the research on REITs, like we did a video and talked about REITs on the podcast a while ago. And it's the same fundamental question. Like, should you hold REITs in excess of market cap weights in that case? Another way to think about that is, are REITs a distinct asset class? Are you getting something by over allocating to REITs that you can't otherwise get from a more diversified portfolio? And the answer in the case of REITs is no. You can get REIT factor exposure, the same economic drivers of REIT returns you can get from a better diversified portfolio of small cap and value stocks, and some credit, some investment grade bonds. Anyway, so I go into thinking about private equity in the exact same way. Is there something we can be getting out of this asset class that we're not currently getting out of the factor tilted portfolio?
Right. Is there a unique source of risk and return?
Yeah, exactly. A unique source of expected return, or an uncorrelated source of expected return. Now, I just talked about the data from PitchBook that last year private equity attracted the most assets ever, at least as far as it's been recorded. A similar thing has been happening in the pension space. There's a paper from a couple of Harvard professors titled "Looking for Alternatives: Pension Investments Around the World, 2008 to 2017," and they showed a similar effect where large institutions have increased their allocations pretty significantly over that time period to private equity. And CPP Investments, they just changed their name from CPPIB. Do you know that?
No.
They rebranded. It's called CPP Investments now. So CPP, the entity that manages Canada Pension Plan's assets, is now called CPP Investments. They used to be the CPP Investment Board. Anyway, so they're mentioned in this paper from the Harvard professors about one of the large institutions that's increased their weight to private equity. So here's just a quote from the paper. On average, in the 10 years following the financial crisis, and the timing is important, allocations to private equity and real estate nearly doubled, representing about 20% of assets under management in 2017 for pensions in many of the largest economies. Our sample indicates a $1.8 trillion shift to alternatives between 2008 and 2017.
Wow.
So big shift.
Big shift in demand, which you would think must drive up prices, reduce expected returns, if nothing else.
We'll get to that, but you're right. Now, I said the timing was important, and this is, I mean, it's tough to prove, I guess, but one of the sensible explanations, I think, for the increased weight in private equity is institutions seeking higher expected returns. And the timing is important because when pension assets took a big hit in 2008, interest rates also fell. So the potential for large unfunded liabilities for pensions increased pretty significantly. So all of a sudden, to make things work, you need higher expected returning assets, which private equity have historically been. And we'll talk more about the historical data in a minute.
Because with fixed income returns falling, you need more assets to get the same kind of return. So either more assets getting that lower return, or assets getting higher other returns.
Yeah. But for pensions too, it's like discount rates have fallen, which means the liabilities have risen. So you're kind of getting hit on on both sides pretty hard, which is, I guess, the same for everybody. It's just the pension liabilities are more explicitly stated. We mentioned Vanguard. That's one of the points I had. Vanguard getting into the space, which does speak to just the idea that increased demand and increased interest in the asset class could affect. Hey, what does your water bottle say on it?
That's what someone talked about. Rational Minder water bottle and my new sweatshirt. Yes.
Someone said it was funny that Cameron always drinks from his Rational Minder bottle with the Rational Reminder label on the side, perfectly positioned.
Yeah, here we are plugging our YouTube channel. Shameless plug.
Oh yeah, right. Because this is a video for some people that are watching it. Okay, so the big question is: does private equity offer something special? Clearly, some people think it does, but does it actually? So there's a paper from some of the folks at AQR titled Demystifying Illiquid Assets, Expected Returns for Private Equity. The paper's fantastic. But they explain that, and it's your comment exactly, Cameron, that private equity expected returns have and realized returns actually since about 2006 have deteriorated pretty significantly. But despite that, new allocations, like the data we just talked about, new allocations to private equity have been increasing. So if you go back far enough, the historical data on private equity is actually pretty great. So are the historical expected returns. So not the actual realized returns, although those were good too. But if you go back in history and use the methodology that AQR used, that we're going to talk more about in a second, if you use that methodology to the past, expected returns for private equity were substantial, so substantially higher than for public equities. But more recently, that has changed. And so we'll talk about their whole paper was basically this framework for evaluating current expected returns for private equity.
Do you have any sense of the breakdown, or is it mainly institutional buyers getting into this space? Like, do you have any sense of retail exposure to this? Any data come across?
I didn't look. I didn't look for it.
Okay.
So I don't know. I mean, it's probably a little harder for retail investors to access, I would think.
Yeah, I don't know if there's retail products in high net worth space perhaps that get rolled up. I don't know.
Yeah, I don't know either. That would have been the direction that I took this if I had decided private equity made sense, but spoiler alert, it doesn't. So I never got to product because product didn't matter if it doesn't make sense theoretically. One of the most interesting things about what the AQR paper talks about is that they say that, so I talked about the higher expected returns being one of the reasons people might be seeking out this asset class. That's one of them. But the other one that I find really interesting is the concept of artificial return smoothing. And what that means is because private equity is not mark to market, like it's not traded daily on the exchange, and you don't get to see the fluctuations daily in your online account or on your statement or whatever, you get a smoothing effect where the returns can look smoother than they actually are, which is interesting. So the AQR paper suggests that could be one of the reasons that people are attracted to the asset class. And that actually has a really interesting implication for expected returns as well.
They're also marketed to long-term patient capital. Like there's a certain amount of pride that I think people take in having long-term patient capital. So it's almost like your brain checks out on that investment for a decade or longer.
Yeah.
Just from a mark-to-market standpoint, not on the investment, just on the value of the investment.
Yeah. And one of the interesting things about that is that you would expect, when you're doing that, you would expect a premium, an illiquidity premium. But that has not shown up. Okay. And the reason I'm giving away I had a methodical approach to going through.
No, go ahead. Don't let me.
Well, no, but it's fascinating. So the AQR paper suggests that what should be there as an illiquidity premium is washed away by the fact that investors have a preference, not related to risk and expected return. They have a preference for smoothed returns.
So they give up expected returns for that?
They're willing to give up expected returns
for a smoother ride
in exchange for what appears to be a smoother ride, even though the economic risks are still there. Wow. On paper, it can look smoother. So their suggestion is that the reason that the illiquidity premium has not shown up in private equity is because people are willing to overpay for it to get smooth returns. So even because what you said is true, Cameron, you got to lock your money up for 10 years or expect to make a private equity investment, which should result in a premium. But historically, that portion of the premium has not shown up. And you can decompose the returns by factors to show that, which is what the AQR paper did. So anyway, private equity can look less volatile and less correlated to the public stocks because of the return smoothing, which makes it look like a pretty great asset class on paper. Now, one of the other things, and this is again speaks to what you said earlier, Cameron, is that the valuation gap, and this is when I talked about expected returns changing over time. This is a big piece of that. The valuation gap between private and public equities has narrowed substantially over the last 20 or so years that they looked at in this paper, 30 years almost. Which may speak to that willingness of investors to overpay for artificially smooth returns, because you would expect a valuation gap to always be there just based on illiquidity. But right now, when you look at private versus public valuations, there's basically no valuation gap, or it's very small anyway. So this paper went through 3 different approaches to estimating expected returns for private equity. And they looked at US buyouts, which is important. So this is not venture capital. This is just buyouts in the US. So the 3 approaches they took were theoretical required returns, historical returns, and a yield-based analysis, kind of like the Shiller-Cape idea for public equities. So theoretically, and they said that they based this on economic intuition and empirical evidence. They said that they expect the private equity asset class to have excess exposure over the market to equity risk, so a higher equity beta, an illiquidity premium, size, so smaller companies tend to be the ones being bought out, and value, because again, cheaper companies tend to be the ones involved in buyouts.
Interesting. Because you're following private equity through to buyout stage.
This is looking only at buyouts as a proxy for private equity.
Exactly. So if you're bought out, you're going to be at the cheaper end. Interesting.
Cheaper and probably smaller too. Yeah.
Small cap value. Okay. Interesting.
Yeah. So that's their economic intuition and empirical evidence. And we'll talk actually about a different paper in a bit about that empirical evidence that I'm not sure if the AQR paper referenced that or not. Anyway. So they give the estimated equity beta between 1.2 and 1.5. Now, this again speaks to the return smoothing. If you do what they call a naive regression, which is just a regression based on the raw data for private equity, the beta looks as if it is less than 1. But they go through a process that I didn't dig into exactly how it works, but they unsmooth the returns of the private equity asset class. And so once you've done that, you should be seeing a truer economic risk profile, a return profile. And so when you do that, you get an equity beta between 1.2 and 1.5 versus the natural unsmooth beta of less than 1. But you start to see how this could look like a really good asset class on paper if you're not kind of digging into the deeper layers. So the obvious implication is that, it's what I just said. It looks less risky on paper, but in reality, it is more risky than the market.
But that just shows you once again, and we talk about this all the time, how at the surface something can look really good, but if it's not your domain of expertise and you don't dig into the corners and understand what's going on, you would never know this.
Now, here's the other interesting thing about that, though, and it again ties back to that preference for smooth returns. Some people might want this. Some people might look at that. Maybe they do know how to look at it. They do unsmooth it, and they say, "Hey, I'll take a 1.2 beta that looks like a 0.8 beta."
For sure.
Because you can get the higher expected return without the associated volatility, which is why people are willing to overpay for it, which affects the valuation. Crazy, right?
Mm-hmm.
So I already mentioned the part about the illiquidity premium going away because of the preference for return smoothing. But that's a really important piece. And we already talked about the economic intuition of smaller value companies being targets for buyouts. So we don't need to go over that again. They briefly mentioned venture capital, and the evidence on that is mixed in terms of whether it's a value or a growth play. But this paper again is focused on buyouts, not private equity. Okay, so that's the theoretical approach. Is that basically what we're looking at is a leveraged portfolio of small cap value stocks, and they use that information to look at historical private equity returns, and that's where they get the idea that there is no liquidity premium or illiquidity premium, because you can fully explain private equity returns with public small cap value companies that are levered up a bit. So that's a theoretical piece. Then they looked at the historical data. So for this, they used the Cambridge Private Equity US Buyout Index, both a smoothed and unsmoothed version of the index. And they compared that to regular public market indexes from July 1986 through December 2017. Now, this speaks to the data I just mentioned a second ago. So the PE index actually did worse than a basket of small cap value stocks over the same time period. And that's where they get the idea that there's no illiquidity premium for private equity. Now, this part's really interesting. For the data that I just mentioned, they used IRRs, which is the available data for private equity fund returns. But they go into a whole commentary on the gameability of the IRR. Have you heard about this?
I have not. I saw the notes. It's shocking.
Okay, so I'm quoting the AQR paper here. So they said IRRs are not time weighted and are affected by both the magnitude and timing of cash flows. Larger cash flows have greater effects on IRRs, and IRR calculations embed a non-innocuous assumption that interim cash flows can be reinvested at the IRR. Thus, PEGPs can time capital calls from LPs as well as deal exits so as to boost IRRs.
We should have given a nerd alert before reading that, but that's really fascinating.
Well, basically, you can
game the numbers.
Yeah, you can game the numbers. If you're managing a PE fund and deploying money and exiting deals, you can do that. Maybe not everyone's doing this. Probably not. What's that? The Hanlon's razor mental model that assume people are inherently have good intentions or whatever. But the fact is, it's possible to game IRRs, which makes them unreliable. So then they introduced this measure called the public market equivalent, the PME, which they say is more common in academic research that's looking at private equity. So this is this involves comparing the amount of capital generated by the private equity strategy relative to a public equity benchmark, assuming similar amounts were invested with the same timing. So it's an ungameable. It's like comparing the actual results of the private equity investment relative to a public market index. And so a PME, a public market equivalent of 1, would mean that the private equity fund delivered the same returns as the public equity benchmark over the given time period. And so they have some charts, which we can post in the show notes, and we'll show them on the YouTube video. If you're watching this, you'll be able to see them. But they looked at the PMEs, the public market equivalents again, for a bunch of private equity vintages from 1998 to 2018. And then they have a chart along with that one showing the valuation gap over the same time period. Now, based on these charts, it seems obvious that there's a relationship, and it makes sense just through common sense, whatever you want to call it, that higher valuations. I mean, what do we know from the Shiller price earnings for public equities? Higher valuations should lead to lower expected or lower future returns, which is exactly what we see in the data here. And the wording they use is that the ex ante valuation has a strong relationship with the ex post performance. Right. So at the time of making the investment, before we know the result, the valuation at that time is directly related to the performance later on.
For sure.
Similar to the intuition that we have from public equities. Now, in the charts that we're talking about here, they use both S&P 500 for the public market equivalent. They use S&P 500, and they also use a leverage size and sector adjusted S&P 600 index. So this is that small cap value E leveraged index. And when they're using that risk appropriate index, the public market equivalent of private equity was less than 1 for most vintages, except for one period from about 2000 to 2005.
Wow.
Which is also coincides with the period where the ex ante valuation gap between public and private equity was the widest. So it's like starting to build some intuition here. It's like historically there have been some periods where private equity did really well. Over the full set of data, it's done no better than a leveraged portfolio of small cap value. over some periods of time, it has done better than a portfolio of small cap value stocks. Those periods followed times where the valuation gap between buying public equities was relatively much more expensive than buying private equities, preceding periods where private equity did extremely well relative to public equity. So that pricing piece, the valuation piece, starts to become pretty important, which makes sense just intuitively. Because now, when you look at that data on valuation gap, it's shrunk to, I mean, I have the chart here. It's well, yeah, you can see it too. It's actually, as of 2018, when they had this paper, September 2018, the EBITDA over EV, over enterprise value, was higher for private equity than it was for the S&P 500. So pretty crazy. And based on this, the AQR paper argues that under normal circumstances, they put a fair amount of weight on the historical experience of an asset class. But specific to private equity, because the market has changed so much in terms of demand and interest and access to the asset class, that they think that the most recent 10-year period, during which private equity has not done very well at all, that period's probably more characteristic of the expected returns for the asset class.
The last decade is.
Correct.
Wow.
And if you look at that, the PME, the public market equivalent, in the chart that we have here, since about 2006, private equity has been worse than S&P 500. It's been about the same as S&P 500. It's had a PME of about 1 for since 2006. But if you compare it to the more risk appropriate benchmark of the leveraged small cap value, it's been underwater relative to that since about 2006. Yeah. So then the final metric they use is the yield based approach, which is that thing that I mentioned earlier. That's kind of like looking at the Shiller price earnings for public equities. Their methodology was pretty involved, so I'm not going to go through the whole thing. But they basically just built out a framework to create assumptions for yield, growth rate, leverage, cost of debt, multiple expansion, and fees, and they used that to do a yield based approach that feeds into their expected returns model for private equity. They had an estimate for fees, which they sourced a couple of other papers on.
Here we go.
This is, it's staggering, really. And this plays right into EQR's expected return estimate, because it's a net of fee expected return estimate. So they estimate private equity fees, including a 2% management fee, 20% carry, hurdle rates, and other fees combined in annualized terms. So in the same way that we see mutual fund fees and stuff like that, in annualized terms, they estimate private equity fees to be 5.7%.
Wow.
Yeah. Wow is right. Okay. So take all of the frameworks that AQR put together to estimate expected returns for private equity for US buyouts. And they got, after fees, 3.9% as an expected return. And their public equity, just regular US stocks, is 3.1%. So still an expected premium, just not an enormous premium. Yeah. Oh, and I also mentioned the chart. I don't actually have it in front of me though, but they have a chart showing we'll show it in the video, showing the expected returns. So following this exact methodology, the expected returns going back in time. I know I mentioned this earlier, so I'm repeating myself, but it's crazy to see how it used to be much higher, just based on all the factors that we've talked about being different then. But now the expected premium for private equity is barely above market cap weighted public equities, and probably below a more risk appropriate,
like a leveraged small cap value.
Right. So we think about, okay, back up. What's the decision we're making? Should we allocate to this asset class? Well, if we can achieve a similar result with a more diversified, lower cost portfolio just by owning small cap value equities, why would we allocate to private equity? And the answer is that we wouldn't. I have one more quote from the AQR paper, and then I have one more paper to mention. So they said, our analysis suggests that private equity does not seem to offer as attractive a net of fee return edge over public market counterparts as it did 15 to 20 years ago from either historical or forward-looking perspective. Institutional interest in private equity has increased despite its mediocre performance in the past decade versus corresponding public markets, and weak evidence on the existence of an illiquidity premium. Although this demand may reflect a possibly misplaced conviction in the illiquidity premium, it may also be due to appeal of the smoothed returns of illiquid assets in general. So it comes back to the theme of people will still own this stuff, even if it's no good, because you get smooth returns. I think actually Cliff asked us a while ago, like a couple of years ago on I think it was Cliff, made a joke about wanted to create an index fund that was locked up for 10 years and didn't report its returns daily because he thought that would give investors a much better result. But he said that the SEC didn't
go
like
for
his
it.
idea.
It's actually not a bad idea. But
yeah. Okay. So if we wrap all of that up, well, it's kind of what I just said, that private equity ends up being buyouts anyway. And this is maybe a little bit different from other things like venture capital. It's a whole other thing. But if we're talking about private equity funds, usually we're talking about buyouts. It ends up being a repackaging of the economic drivers of return for small cap value stocks. And you end up with an illiquid asset with no liquidity premium, which is a pretty bad trade-off. You do end up with smooth returns, which if there's any agency issues involved, like if you're reporting to someone else, I mean, I guess this could even be applied to us, although I would never use it as a reason to use the asset class. But if you're reporting your returns to somebody else, this could be a way to make them look better, which is, according to this research, arguably one of the reasons that the expected returns for the asset class have declined. So this is the other paper that I was going to mention. There's a 2017 paper from Harvard's Erik Stafford titled "Replicating Private Equity with Value Investing: Homemade Leverage and Hold to Maturity Accounting." So basically what I was just saying. And in that paper, he found that private equity returns can be replicated using a leveraged portfolio of public small cap value stocks. He looked at that same U.S. Private equity index from Cambridge Associates. And he also, this was interesting, in this paper, Erik Stafford looks at the Yale Endowment buyout portfolio. So at the Cambridge Associates U.S. private equity index as an aggregate index, but then also specifically at the Yale Endowment buyout portfolio. So those are his proxies for private equity. He agrees in his paper with what AQR said, not specifically agreeing with them, but he comes to the same conclusion that large institutional allocations to private equity are largely driven by that underreporting of risk, that smoothed returns. And then his argument to that, which I guess we've kind of alluded to, is that you end up with an overallocation to assets that look less risky on paper, but are actually riskier in reality. Which, again, as I mentioned before, that for some people, maybe it's a good thing. But I think in general, it's, unless you really understand what you're doing, it's probably not a good thing. So I pulled one quote from the Erik Stafford paper that I thought was really good. So he says, popular stories suggest that private equity investors add value through operating improvements, preferred access to financial leverage, and improved monitoring and governance. And that's like, this is no longer the quote. If you think about that, that's a really good narrative, to think that these smart private equity investors are going to go and improve the company and make operating improvements. Okay, now I'm back into the quote. These stories most clearly map into private equity investments, delivering higher mean returns than similarly selected public equities held with similar amounts of leverage, but this does not appear to be the case before fees. After paying fees, which are estimated to be 3.5 to 5% per year, so his estimate's a bit lower than the AQR one, investors who agree that the risk match between the private equity index and the two replicating portfolios is appropriate are considerably underperforming the feasible alternative of investing in similar passive replicating portfolios. So he's basically saying small cap value with leverage maps really well to private equity historical returns. And if you buy that, why would you pay private equity fees, which are really high?
That's the punchline.
That's how I would summarize this thing.
Right.
Oh, and I do have a couple more points on private equity. So if you're investing in private equity funds, the other, like as opposed to an index, I guess, to the extent that I don't know how investable the like a total market private equity index actually is. Could be interesting for future research, but anyway, there's a report from McKinsey, their 2019 private market report that looked at, and I thought this was fascinating, looked at Morningstar data on the dispersion of returns for private equity funds versus public equity mutual funds. And I have the chart here, which again, we'll post in the video, but the dispersion, the difference in dispersion is enormous.
It's got to be a huge dispersion on the private equity funds.
Do you can see the chart there?
I can, but I mean, intuitively, that's what you would expect.
Yeah. So massive dispersion, like the fourth quartile versus the first quartile for private equity is vastly different. Whereas for mutual funds, relatively, it's really tight. And so the obvious next line in thinking is, well, okay, if there's huge dispersion, then you just have to find the winning private equity managers. So I thought about that, and then I found a paper to help me think about it. There's a paper on persistence in private equity fund performance. And this paper that I found looked at private equity managers from 1974 to 2012. And they found that over that time period, and this again speaks to the idea that private equity is becoming a more popular asset class. So they found that the persistence of fund managers has substantially declined as the private equity sector has matured and become more competitive. Private equity has therefore largely conformed to the pattern found in most other asset classes in which past performance is a poor predictor of the future. But the fascinating part is that as the space gets more competitive, that becomes increasingly true, where you'd be less likely to have persistent success as a private equity manager. So now we've got this big dispersion, and past performance is no predictor of.
So more money, more investments, more people chasing, more analysis, tighter spreads that are available, but yet wider dispersions.
Lots of dry powder out there, lots of private equity funds with a lot of cash to invest, lots of public companies that are competing with private equity funds to buy up other businesses. But it's just fascinating to think that an asset class like this, that today looks like a less regulated version of public equity, but in terms of the empirical evidence on the returns of the asset class, looks remarkably similar to public equities. But the interest in the asset class is driven by the historical performance, which occurred when the asset class was structurally totally different. Mm-hmm. Like the relative valuation of a private company, 25 years ago was so much lower than a public company that it arguably made sense just purely from a rational expected returns perspective to make the investment if you could get into it. But now there's so much money chasing the private equity investments that it's, from a valuation perspective, it's no longer an attractive opportunity. Then you tack fees onto that, you tack difficulties in diversification on top of that, and then dispersion on top of that. And it's like, I don't know how you could make an argument that this makes sense from an expected returns perspective. That's not to say, and we see this in the dispersion data, that's not to say some private equity managers won't do well. And some investors in some private equity funds, I'm sure that will have great outcomes. Some will have really bad outcomes, which is the nature of the dispersion.
Right.
But as an asset class, in terms of an expected return profile for an asset class and whether or not it makes sense to add to portfolios, nope, wouldn't touch it.
And that is the ultimate punchline. On to our planning topic.
Yeah.
Okay, so I'll give you a break a bit here. So this week we're looking into something we talk a lot about with clients, which is the topic of spousal loans. So many investors certainly have a goal to reduce their overall tax rate, their overall tax bill. And one way for a lot of couples to do this is to do what's called a spousal loan. So this involves one spouse. Often you have a situation where one spouse has higher income and has higher asset levels. So what the CRA allows you to do, our tax authority allows you to do, is to make a prescribed rate loan where the higher income spouse will lend money to the lower income and lower asset spouse for a prescribed rate of interest. So that interest currently for this current quarter is 2% and is falling to 1% for the next quarter starting, well, when this episode airs. So you can make that loan, it's a demand loan, at what will be 1%. So the lower income, lower asset level spouse pays the other spouse 1% interest every year. Then all the gains above that are taxed in the hands of the borrowing spouse. So it's a way of getting the income off that asset, off the higher income bracket spouse. Pretty common planning.
Is it worth mentioning just the concept of attribution?
For sure. So the reason is you cannot simply give your spouse that money to invest. So if you had $1 million, Ben, you simply can't give your wife, if you earn that $1 million, you can't give that money to your wife and have her earn it or grow that money, because any income from those investments come attributed back to you. So attribution rules is a big thing to watch for. I think a lot of people aren't aware of that. They just give their spouse the money. Yeah, you put it in your account, you invest it. No, you can't do that.
That's, yeah, a common one of just common, I wouldn't even call it a misconception, but a common error that people make is assuming that a joint account is automatically split 50-50.
Nope.
Like putting money into a joint account is not tax planning.
No.
It's still, it attributes the income and gains in the case of the spouse still attribute back to the person who the money originated from. So a gift to a spouse is not income splitting. It has to be a loan at the prescribed rate.
Go ahead.
Though the piece on capital gains, attributing back only is for a spouse. It's actually, I don't know why this is true, but it is true. For a child, attribution still applies. If you give money to your child, and I think it includes a niece and a nephew as well, but don't quote me on that. That's a less common one that I've seen in practice. But for sure to a child, like if I give money to my child and invested in a trust, in an account that's in trust for them, the income attributes back to me. The gains, capital gains, actually attribute to the child for tax purposes, which is interesting. For a spouse, it's the income and the gains. But in both cases, you can make that go away by making a loan at the prescribed interest rate.
And that rate is set, as we said, every 90 days. And it's set by CRA based on the average rate of 90-day T-bills sold during the first month of the preceding quarter, rounded up to the nearest percentage point. So for the longest time, it was 1%, then it popped up to 2%, and now it's falling back down to 1%. Now you have to watch that you make those payments. So the interest must be paid by January 30th of the following year. So if you were to make a loan today, you have to make that 6 months of interest by January 30th of next year. If that interest is not paid, then any income earned by your spouse may be attributed back to you.
For the life of the loan too, I think, right? Like it's a pretty steep...
it's a very steep penalty, yeah.
Yeah.
But what's cool is when you do the spousal loan at 1% next week, that interest rate is set for the life of the loan.
That it is cool at 1%. At 2%, it was less cool. Which,
yes, it's cooler.
But it introduces an interesting scenario, right? Where if people had made a loan, and we were still suggesting to clients to do spousal loans at 2%, because there's still, if you include capital gains, there's definitely an expected advantage, even just on the income yield from a portfolio. Say it's 2.6% on average for a portfolio split between Canadian, US, and international stocks. There's still 0.6% that's being split.
On income, like that 2.6 is coming to you anyway, so why not do the loan and only 2 is going to come back to you. You're pushing 0.6 to your spouse plus any gains.
Right. So that's compelling for sure. Not as compelling though as 1%.
Right.
So now the question becomes...
So we had 4 scenarios here, right? First of all, does this make sense to do? Let's forget about the change in interest rates. So let's say it makes sense for you, but you have in your portfolio a large unrealized gain. Should you do it? Because if you have that amount of money in your hands, Ben, with large unrealized gain, is it worth triggering those gains to lend the money? Because you can't just go and give that asset and the cost base to your spouse. So you have to do some tax calculations there of the present value comparison between paying that tax now and the expected benefit of doing the loan and pushing the income to your spouse after paying that tax. So a little bit of spreadsheet work for that. Now, what about if you have a large unrealized loss? Should you do it? And that's where you have to be really careful, because if you trigger the loss and your spouse goes and buys the exact same property within 30 days, then the capital loss is denied and they end up with your cost base. Now, that may not be the end of the world, though. Right?
Yeah.
Again, to fire up the spreadsheet.
Yeah. Well, yeah. So you might accept the superficial loss. Yeah. The other tricky one, and this may be in 3 or 4. No, I don't think it is.
So go ahead with yours.
Well, it's just that what if in that case of a loss, what if the amount in the portfolio is not sufficient to pay back the loan?
Well, that's the issue that's coming up now.
Yeah. Okay.
So let's say you did a loan at 2% and there's an unrealized gain. Should you repaper it? Right? That's an unrealized gain. So the borrowing spouse would trigger the gain, pay back the loan, reborrow the money, will likely be out of the market for at least 4 days just because the money has to properly flow between the proper accounts. So you have to figure, okay, how much tax is due on that gain you're going to trigger, and compare that to the benefit of only pushing 1% now to your higher income spouse and keeping more of the income in your hands. So again, you have to do some calculations. But what if you're upside down on that loan? So you borrowed $1 million, it's worth 900, right? So you have an unrealized capital loss. You sell, you pay back 900 of the million, you borrow back 900. So now you're left with 100,000 at the old 2% and 900,000 at the 1%. You triggered the loss, but then you buy back the same security. So now you have to track 2 different loans, the old $100,000 loan and the new $900,000 loan. You have to watch your day counts carefully, because now you have, I think everyone gets this, you have 6 months at both loans. So when you make your payment by January 30th of next year, you better make sure you're doing this. Like, this is careful, finicky. It's not complicated, but it's careful and finicky type work that you have to do this properly. And highly recommend you seek advice from your tax and legal advisors.
I don't even know if I would say that it's not complicated. It's not hard. Maybe complicated is not the right word. It's intricate, tedious.
It's intricate. It is. It's kind of like the Smith maneuver when we talked to Robinson. People get it, but it's finicky, fussy type work.
Worth it.
Definitely.
We have a calculator that we built to assess whether or not this makes sense for clients, just to make it quick. And the present value, like I can't just throw a number out there because it's obviously dependent on each individual situation. But in a lot of cases, the present value of expected tax savings is close to or above $100,000 over the lifetime of a loan. So it's not like, not chump change. Now that might be an extreme case, like if one spouse isn't working and one spouse has the income at the highest tax rate. That's the type of assessment that you got to do.
You also have to look at what will their tax rates be in the future, because if you end up in the same tax rate, say in 5 or 10 years, and the life of the benefit isn't as long, of course, the present value of the benefit will be lower. So there's so many factors that go into the tool that we've built. That is complicated. A lot of assumptions. And there's also a lot of debt forgiveness rules, not a lot, but there are debt forgiveness rules. So if you happen to be upside down and you don't have sufficient capital to repay the loan, part of the loan may be deemed to be forgiven, and that's when debt forgiveness rules apply. Suffice to say, the rules are complex, and I'm reading here, but in general, the amount not repaid, will be deemed to be forgiven and first used to reduce certain tax attributes of your spouse, the lending spouse, if available. The tax attributes that will be reduced include, and this is in order, non-capital losses, farm losses, restricted farm losses, allowable business investment losses, and net capital losses carried forward in that order. If your spouse's losses are insufficient to absorb the forgiven amount, they can then choose to reduce other specified tax attributes, such as the adjusted cost base of certain property held by the lending spouse. If there is still a forgiven amount remaining, then 50% of that amount will have to be included in your spouse's taxable income in the year the unpaid amount is forgiven. Ben's shaking his head. Like
this stuff makes me sick. This is the kind of thing that makes me very glad to have someone on our team who is a CPA with immense tax expertise.
Now, what about if you die? So if your spouse dies while the spousal loan is still in existence, if the loan becomes a debt of your spouse's estate and it becomes a debt of the spouse's estate and needs to be repaid. If there are insufficient assets in the estate to repay the loan, and the loan has to be forgiven by you, then the debt forgiveness rules would apply. However, if a spousal loan is forgiven in your will, the debt forgiveness rules do not apply.
Oh. So you want to make sure it's in your will if
you want to make sure it's in your will according to the research that I did on this. You bet.
Wow.
The debt forgiveness rules can result in unintended consequences, and for this reason, it is essential that you consult with a professional tax and legal advisor if you intend to forgive a spousal loan. That's from the article I read.
If you intend to forgive a spousal loan, which inherent in that statement is probably if you intend to make a spousal loan, because you don't know whether or not it would have to be forgiven in the future.
Exactly.
There's no way to know.
Exactly.
Unless you make a strong assumption about positive expected returns, I guess.
Exactly. Not that you expect negative returns, but stuff happens, right?
You never know, yeah.
But point being, it's a simple concept that a lot of people are aware of. Whether it makes sense for you is not simple and takes some thought.
How many people are aware of it, though? There's the idea of prescribed rate planning and spousal loans. I'm sure maybe listeners to our podcast where it's a biased sample, but in general, having conversations with people, I don't know.
I know of people that have done it that don't have the loan agreement, haven't made the payments.
Oof. Well, yeah, given money to a spouse for sure.
Yeah.
Oh, well, that conversation I mentioned earlier has been.
Well, do it as I'm saying, doing it as a loan, not just a gift, a loan.
But an unpapered loan with no interest payments.
Correct.
Sounds like a gift. Sounds like a gift to me.
Anyways, anything to add to this topic?
No, I mean, I think that the reason that we brought it up in the podcast is that the prescribed rate is falling from 2% to 1%, which, like we mentioned earlier, makes this type of planning go from pretty good and worth considering to, for the right situation, to being really good and nonsensical to not consider.
Yeah.
And we won't go into any detail about it, but the extension of the idea of loaning to a spouse is the idea of setting up a family trust, which is a whole other topic.
That's another week.
If there are kids in the picture, then you can kind of take the idea of a spousal loan and expand that to dependent children.
Okay, don't spill all the candy in the lobby here. Okay, on to bad investment advice of the week quickly.
Yeah.
And this one is from the Here We Go Again file. So this week I had some fun on Twitter with some industry peers or colleagues, Jason and Dan. So we had some, I guess, nerdy laughs at the expense of our industry from 2 decades ago. So Dan, I reached out. He remembered some of the fund manager names I couldn't recall when we recorded 2 weeks ago. And we just were laughing amongst each other about some of the ideas that came out like 20 years ago by the fund industry. And then they go and market these ideas like crazy. Names like we were discussing CI Boomernomics, Talbot's New Economy Fund. And lo and behold, this week, the industry serves up another one, which mind-boggling to me. So the thesis is this. So the idea is people are living longer than ever before, and CI Investments thinks certain companies will be able to cash in on this trend. So they recently launched what's called the Global Longevity Economy Fund. Be available as a mutual fund or an ETF, and the fund invests in companies, and I quote, that are benefiting from changes in consumer behavior, technology, and healthcare resulting from the trend towards longer, healthier lifespans, according to their release. So, of course, cue the author Cue the book. So the new offering is being inspired by the insights and research from Joseph Coughlin, who is a global expert on demographic change and author of the book, The Longevity Economy, Unlocking the World's Fastest Growing, Most Misunderstood Market. I mean, this is right out of the 90s. Like, it feels so much like the 90s. Quote, given the broader trends and demographic shifts occurring around the world, we are providing investors with the opportunity to invest directly in companies that are poised to thrive in the longevity economy, the CI CEO said in a statement. So once again, take an idea, make a product, throw it on the shelves, and see how it sells. I mean, it literally is the mid-90s all over again.
I'd love to see data on survivorship. Like we know for just average mutual funds, survivorship is about 50% over 10 years. I'd love to see thematic or whatever you call this.
Well, I'm sure, well, we'll get Dan. Dan will go and work on it, I'm sure. I know Dan listens, so he'll be getting a good chuckle now.
It has to be lower than 50%. You'd expect that because trends come and go, obviously.
Right.
Brutal.
Here we go again. Anyways, that's not a judgment on the author. I'm sure the book is fabulous at all. I'm talking about the benefit of wrapping it up in a product and selling a product around it.
Nothing can be as acute as the marijuana boom in terms of product proliferation.
That's a pretty good
and
one.
Probably closure. I haven't checked up on how many of those products have closed now, but yeah, if it's that disconnect that we've talked about in the context of the economy, that or in the context of economic growth versus stock market returns, but that disconnect between expected future growth of a thing, economy, industry, whatever you want it to be, the disconnect between that and expected stock returns for
Right.
that thing. I mean, for the economy, we even found in that research that it was negatively correlated because people overestimate growth.
Right. It's a good story, though.
Yep.
Anything else to add?
Nope, I think that's good for this week.
As always, thanks for listening.